Good afternoon, everyone. I see Carlos joining us, Celine, Anna, Jacob. Nice to meet you all. So welcome to our webinar on the 2026 and 2027 flexibility market, where revenues are shifting. So flexibility will be a feature of interest going forward, and all current and future assets will have to be flexible to manage shocks, oversupply, negative prices, and so on. So today we will take a near-term overview on how flexibility is monetized today versus what expectations we have in the next year, what works in practice, what doesn't, in storage revenue stacking, of course, and finally, all to help you make strategic choices around asset design, contracting, and market participation. Okay, so this is the structure. So welcome. This is the webinar opening. And then we will have presentations by Jon Ferris, who will cover more of the system overview and the market overview. And then we will cut to Elisha Wong, who will then cover the asset, revenue, and strategy perspective. So you are in our webinar. A bit about Solarplaza is that we're established in 2004. So we're 22 years old right now. And we organize lots of conferences around renewables, specifically solar and storage, because we believe that the sun is the solution. And we're really glad to have you join us today in that vision. Any questions? So if you look on your top right where I'm pointing, there is a question box. If you have any questions for the presentations, as I'm sure you will have, please put them there. We will get to them at the end of the session. There's time for it. And if you run into any issues, there's also a technical box as well, so just put it in the questions, and my colleague who is here, Radmila, will help you. She is great. And I'm sure everyone is interested. The slides and full recordings will be available afterwards, so you'll receive an email with instructions. So no worries, everything you learned today, you will be able to get it as well. All right, then without further ado, I invite the first speaker to turn on his camera, his microphone. I invite a market expert who's over 20 years of experience, and he is well known in taking a systems point of view as a systems architect. So the head of flexibility and storage from LCP Delta, Jon Ferris, you have the floor.
So thank you very much. Like I say, I'm head of flexibility at LCP Delta, and we're a research and consultancy firm that's very focused on the energy transition and has been for 20 years. We cover both upstream and downstream markets, but for the next few slides, I'm going to focus more on the market structure and downstream participation in market flexibility. So I'll be taking a broad view across Europe and using slides based on the LCP Delta Smart N Market Monitor, where we've been tracking evolution of the markets over the last 7 years. So the charts and graphics are at the end of 2025, but I might mention some major announcements and major progress that we've already seen for some countries in the last few months. And the reason I'm looking to focus on the downstream participation in the markets and focus on behind the meter assets and smaller assets is that that's a small part of market participation today, but potentially a huge part of the flexibility provision in the future. There are over 10 times the battery capacity in EVs than we have in grid scale storage already. Add to that the flexibility from industrial load, from heat, whether that's residential space heating or industrial heating. The potential for flexibility from the demand side is huge. However, access of flexibility through independent aggregators to wholesale markets is somewhat limited. Now, wholesale markets are the deepest and the most liquid markets for flexibility, but they're still, as we've seen, susceptible to price shocks. Bringing demand-side assets into these markets can mitigate the impacts of price shocks, whether short-term or the longer term market evolution that we've seen from the growth of solar generation that's increased the prevalence of negative prices across Europe, particularly Germany, Netherlands, Belgium, and all of a sudden in Spain as well. But in those countries, the demand side cannot access the wholesale markets. We've also seen some moves, particularly in France and GB, to enable independent aggregator access to wholesale markets with flexibility, but limited impact so far. Onto capacity markets, which is another source of value, and that the stable the support for assets that get a capacity market contract supports the ability to raise finance to invest in the assets. There's been little progress in the last year over the participation of demand side assets in capacity markets, and as you can see from the charts, there's quite a bifurcation across Europe, that some markets do have capacity markets that support the revenue stack and investment, others don't. Where demand side assets and BESS can participate in the markets, they're often derated, so the amount of revenue they can get compared to thermal generation is limited. So a lot of capacity markets are still supporting the incumbent generation, and demand side flexibility is still underrepresented in the markets. We've also been talking about introducing capacity markets in Spain and Germany for a number of years. And I think that illustrates the amount of time it takes to get a capacity market set up and to bring liquidity into the markets. We do expect more countries to introduce them over the coming years, but at the moment the opportunity is somewhat limited. That's quite a contrast to the TSO ancillary services markets, where across most of Europe, the markets have opened up. We've moved away from bilateral contracts that supported the grids in previous years. We had hopes that there'd be more progress in Spain last year, and I'm quite pleased to say that the announcements recently have certainly been a step in the right direction of opening the markets and allowing particularly independent aggregator access to those markets. There's still a lot of detail that needs to be sorted out, but in general, it's broad progress to opening up the markets. On the other hand, we have seen compression of revenues in these markets, particularly in countries where grid scale batteries have appeared at scale and somewhat swamped the need for products like frequency containment reserve and AFRR. They're a key part of the value stack, but certainly not as lucrative as they were a year or two ago. In terms of local markets, I think this is where we see much more of a difference, much more of an opportunity for smaller assets. The larger the battery, the higher up the voltage levels it's likely to be. But we're seeing congestion at a low voltage level and at medium voltage level, and seeing the introduction of local flexibility markets and DSO procurement of flexibility. That congestion is partly driven by the growth of solar on residential rooftops, but also the growth of EVs and heat pumps and the general growth in electrification. I've highlighted the Netherlands as being an area where you've got extreme problems with congestion. It's also one of the countries that's most advanced in developing markets for local flexibility. So I think that shows there's an opportunity that's still untapped to provide flexibility and reduce the congestion and the challenges that the market has. There are a few countries that are leading in opening up markets, but DSO and local flexibility markets is likely to be one of the areas where we see a growth in value in the coming years. We simply can't build enough grids at the local level. The challenges and the scale is too high to meet the need. We will need more flexibility, and there are opportunities for flexibility that are not necessarily open to the large scale assets. So I think we'll see a difference in the value stack between smaller assets and larger assets, supporting the evolution of the grid at different voltage levels. And finally, the development of retail tariffs for flexibility. We've seen much more interest in dynamic tariffs over the last few years, price signals being passed through to consumers either based on day ahead prices or through time of use rates that allow for or that encourage grid friendly behaviour, particularly during the winter evening peak, reducing demand. We've also seen a change in network tariffs. France is an example where what used to be considered peak during the middle of the working day is now seen as off-peak during high solar generation periods. So some regions that have solar congestion are incentivizing behaviour that reduces that congestion through the network tariffs. However, the willingness to expose consumers to volatility is being tested the more that we see price shocks, whether it's from COVID, from the invasion of Ukraine, or the current war in Iran. Norway was really the leading country for consumers on dynamic tariffs up to last October. The introduction of a flat subsidized tariff for consumers in the regions that are most exposed to price volatility has seen probably the biggest uptake in consumer opt-in, with more than 60% of consumers now on the flat tariff. So consumers exposed to volatility is one way to address the challenges that we're facing and deliver value for flexibility. It's not necessarily something that's been seen as politically acceptable. At this point, I will hand over to Elisha. He'll talk about the large scale batteries.
Thanks, John. Good afternoon, everyone. Firstly, thank you to the Solarplaza team for having me today. I'm Elisha Wong, a commercial analyst at Gore Capital, and today I'm focusing on a BESS owner-operator's perspective on shifting revenue and how to create value in today's market. So firstly, to give an overview of Gore Capital, we manage 3 investment funds that invest in utility scale battery energy storage. Gore Energy Storage Fund is the first one, the first energy storage listed fund on the London Stock Exchange. We have a Gore Japan fund with Itochu, and recently we have a new €500 million EU fund targeting continental European markets. So altogether, we operate and have under construction about 1.4 gigs of BESS across 6 markets globally. So historically, BESS has participated in 3 types of revenue streams simultaneously, 2 of them being merchant and 1 contracted. Looking at the diagram below on the left, the first merchant revenue is ancillary services, or more specifically, frequency response or balancing services. Some of these examples in Europe are like what John mentioned earlier, like frequency containment reserves, EFRR, MFRR. Also on the left, you have wholesale energy trading, where simply you buy energy at a cheap price and you sell it at a higher price. On the right, you have contracted revenue in the form of capacity markets or mechanisms. And some examples of this are like the capacity market in GB, Ireland, Poland, to name a few, or the MACSE and Italy. So a global challenge today for BESS, as what Jon mentioned, is the saturation or cannibalization of ancillary services revenues. This is mostly due to the rapid build-out of BESS, but there being limited procurement volumes in these services. On the graph below, to use GB as a case study, this graph has been provided by Modo Energy, shows BESS revenues peaking in 2022, before sharply falling in 2023 into 2025. This drop is mainly from the compression of ancillary services, which you can see is the yellow portion of the graph. Another thing to note is that the purple portions, which includes both wholesale energy trading and balancing mechanism, have increased in the last 2 years. Basically, to summarize the graph, it's saying that ancillary services revenues will saturate as a market matures, and energy arbitrage is the long-term revenue driver. With this challenge in mind, there are two key areas that owners, investors, and developers must consider when designing a BESS. Firstly, market design, and then grid requirements. So on market design, firstly, duration. This is often determined by the revenue mix in each market. In some markets, this is a lot clearer. For example, in Italy, to participate in the MACSE auctions, your BESS would need to be at least 4 hours, or in Poland, the capacity market requires units to deliver their contracted capacity for about 4 hours. For other markets, this might not be as clear, as it depends on the available wholesale price spreads. For example, in Spain, you have large periods of solar in the day, which will result in an excess amount of energy on the system. So a longer duration, say a 2 hour or 4 hour, will allow you to charge up during that period and to discharge in the evening peak. Another thing to consider is the speed of response. So in some markets like Ireland, frequency response requires you to deliver in sub-second speeds. So think 150 milliseconds, I think. Whereas in other markets like GB, it's about 1 second, and across continental Europe, in the FCR, it's initiating within 10 seconds. So obviously this directly impacts your inverter technology selection. If you want to participate in faster services, your inverters will need to be spec'd accordingly. Lastly, technical services, which is something that is gaining lots of traction, as Jon also previously mentioned. As renewable penetration increases into many different grids, a lot of the larger, older conventional generators are shut off, and they don't provide some of these services. Some of these services can include things such as synthetic inertia, reactive power services, or even black start capability. The other key area to consider is grid requirements. Grid curtailment is becoming more and more common as grids are just getting more congested with more projects being connected. This can affect the BESS revenues, as they would have to follow a specific operational pattern, and they won't be able to export in the day when, say, there's a lot of solar. Another thing we've been seeing a lot more is flexible connection agreements. This is something that we've been seeing in Germany a bit more. Spain is also currently undergoing a consultation for flexible demand access. In these agreements, your network operator would define your operational pattern, which can include things like a specific ramp rate to get to full power, capacity limits during times of congestion, or even partial ancillary services participation. Obviously, these limitations will dampen your BESS revenues and ultimately affect the business case of the project. Another thing to note is grid stability. So in some European markets, portions of the grids will be over 40 years old, meaning that there might be a lot of reinforcement works taking place, and your asset will require certain downtime. Moving on, so how can BESS owners capture value in this increasingly competitive BESS space and still achieve their desired returns? So starting at the top, you have merchant revenues. and contracted revenues. So merchant revenues provide the upside. They benefit from volatility, congestion, and a good optimization strategy. They are more variable when the markets are, but when the markets are moving, they can deliver large returns. However, on the flip side, there is risk. For example, in Texas, which is a market that we operate in, where revenues depend heavily on extreme periods of extreme scarcity. These periods are typically driven by extreme weather events. You can see prices being pushed up to $5,000 per megawatt hour. But what happens if none of these events occur in a given year? And what happens if that persists for more than a year? So you see your revenues collapse, even though your assets are performing exactly as designed. That's where I think contracted revenues come in, and they sit on the other end of the spectrum. They provide predictable cash flows and downside risk protection. And these can take different forms, things such as like tolling agreements, revenue floors, day-ahead swaps, and other structured hedges. Each of these structure gives you a balance between stability, flexibility, and exposure. Today, owners don't have to just strictly choose one or the other. Hybrid structures exist. You can get things such as like partial tolls or a partial toll with partial merchant exposure. Ultimately, what matters is finding the blend that matches your return profile and risk appetite. Now, moving to the lower row is 3 considerations when it comes to choosing the right route to market, or RTM for short. Firstly, asset-specific optimization. No two BESS assets will be the same. There might be different locational opportunities or locational curtailment or different grid constraints in each area. So now I think now it's even more paramount that your RTM must tailor their strategy to the actual asset rather than using a one-size-fits-all approach. Another thing to consider is market access and capability. So RTMs must not only forecast and optimize well, but they must also be prepared for new services. To use GB as an example again, we've cycled through multiple changes in ancillary services. We started with FFR, then we moved over to the Dynamic Services Suite, and then we introduced the reserve services. And each new services comes with new requirements, testing and registration steps. And if your RTM isn't ready on day one, you miss out on revenues that you can't get back. Lastly, owner oversight. This isn't technically how to choose a RTM, but as owners, we cannot just be passengers to an RTM. We need to actively benchmark performance, challenge decisions that they're making, and stay on top of new markets. This means that we hold RTMs accountable for the performance that we want, and being early to new markets often creates the most value. So as BESS revenues compress due to saturation, the owners who take a proactive approach to strategy will be the ones who stand out, whether it's choosing the right balance between merchant and contracted revenues, or selecting an RTM partner who can tailor strategy to each specific asset. These decisions ultimately will determine who captures value and who doesn't, especially in an increasingly competitive market. To close, I have 3 takeaways for you. Firstly, energy arbitrage will be the long-term driver of revenue. You should expect ancillary services revenue to saturate. Secondly, manage your downside risk by finding the right mix of merchant and contracted revenues that suits your return profile. And finally, choose and manage the right RTM partner. And with that, I thank you all for your time and listening.
Thank you to both our speakers. I would like to invite you both on. This is the question portion of the webinar. We have time for some questions. Audience members, if you can see on the top right, if you have any questions, please write them down to us on the question bar. And yeah, we will ask the speakers. All right, maybe to start off, I have a few questions of my own. Maybe to go back to the one slide below from you, Elisha, you said that RTM oversight is critical, so to choose and manage the right RTM partner. why is this important, and how can one identify the right one?
Yeah, so I think obviously how they approach things really matters, and how they forecast prices and optimize really matters. But I guess the big thing that I was pushing for is choosing an RTM that is market ready. So, for example, in Germany or Poland, or I think maybe parts of Europe, you have this thing called balancing group. And in order for you to participate in some ancillary services, you need to be part of a balancing group. And given the fact that a lot of these new markets are, well, new, a lot of these balancing groups have not been established yet. And so you might pick an RTM that is not ready for ancillary services delivery on day one. And ultimately, I think that leads to lots of revenue loss, especially if we expect markets to start off really hot. Ancillary service prices are really high, and then slowly saturate and slowly compress down to more energy arbitrage. If you're not there on day one, you are likely losing out a big portion of your revenue streams.
Okay, John, I see you nodding a little bit. Do you have anything to add?
Yeah, I think there's a tangible example of this in the GB market when dynamic containment was introduced. And as Elisha mentioned, there are new markets that are coming in. I think the need for faster response is something that we've been expecting for a number of years, and we are seeing as the rate of change of frequency increases, the level of inertia goes down. So what used to be the frequency containment reserve, which allows assets to ramp up to maximum input in 30 seconds, is too slow. We need markets that can respond within seconds, even sub-second. And if you don't have the capacity to deliver that, then you can't participate in those markets. And that's something where large batteries do have an advantage. If you're aggregating small assets, then the latency from communicating to the cloud platform, possibly to the manufacturer's platform, to the assets, really doesn't help the speed of response and the confidence in that response. So yeah, being able to respond sub-second to the new markets that are appearing is I was going to say it's an advantage. I think it's becoming a requirement for route to market providers.
Okay, and where are the route to market providers right now in meeting that speed?
I can let Elisha take that one.
Yeah. So I think it's a mix. It's not necessarily just your route to market, it's also your inverter technology. So you need inverters for your batteries that can react at that rate. So yeah, like what John was alluding to earlier, a lot of markets are moving towards a faster rate of response. The route to market typically just operates sends signals to the site and controls the inverters, but I think at the end of the day, it boils down to the inverter technology that you decide as a BESS owner. And so if you're not up to date with future market arrangements, you might be building a BESS that is too slow for 3-4 years down the road.
I see. So there's a risk for planning for now. Your battery might be too slow for later.
Exactly.
And kind of everyone keep that in mind. Okay, I see. I also have a question coming in. So I think it goes for you, John, on the capacity market. I think they were more wondering, why is that such a challenge? If that is, I'm rewording it a little bit, but more the question is, why do so many countries struggle with the capacity market, and what can we do in lieu of the lack of it?
So capacity markets are often seen as a distortion to the price signals that the wholesale market delivers. And between countries, Elisha mentioned Texas. Texas is quite well known as being an energy-only market where prices can get very high in the short term, and that delivers the revenue that supports investments. Capacity markets tend to dampen the price signals for operations and are not always seen as appropriate for markets. There's also challenges of how do you allow all potential participants to participate in the markets. The first GB capacity market was actually halted when it was taken to the European courts for not allowing demand response to participate in the markets. So the rules need to be set up such that generation, batteries, and demand side assets can participate on a level playing field. Some countries have taken a slightly different perspective, and rather than having a whole market, capacity market, where the amount of generation needed at peak times is essentially administratively determined and set, and that defines the parameters of the capacity market, they take an approach of taking generation that would otherwise close out of the market and supporting it with a strategic reserve. Germany did that a few years ago to keep coal plant from closing. Sweden also has a strategic reserve where plant is contracted to stay open for those times of need. So there are different approaches. If there isn't revenue from the capacity market, then it does need to come either from a strategic reserve, or which isn't open to all assets, or in the wholesale market. So there are different philosophical approaches that are taken in different countries.
Okay, I hope that answers the question. Elisha, do you want to add to that as well?
No, I have nothing there.
Okay, so well captured, Jon. Then I think we have time. I want to do maybe a final wrap up. I will ask this for each of you. And I'm curious to learn, both of you. You are both like experts in your own field and you work across multiple markets. I want to know, what is your one main expectation going ahead in the next year? And let's start with you, Jon.
So value is dynamic. I think we've seen that from the charts that Elisha showed, but also from the introduction of new markets. So my expectation for the years ahead are that we'll continue to see value move from one market to another. We've seen a lot of focus in the last year or so of value in the day-ahead market. I suspect day-ahead value will compress, and we'll see that value shift more towards the intraday markets. We'll see value move more towards closer to real time, the very fast reacting services, and also into the more local services, the local congestion. I think we'll see needs for new markets. Elisha mentioned a few, but I would add voltage control. That's becoming more of a challenge. And I think that the complexity in the markets is just going to increase, and the need to optimize across multiple markets is going to become more important.
Thank you, Jon. Elisha?
Yeah, I think I echo what Jon said. I think in the BESS space, it has always, at least in the last couple of years, been frequency response, and frequency response being very, very important to balance markets. But I think BESS is very, very well placed to deliver on very many different services, like synthetic inertia, reactive power. And I think as we see more and more grids across Europe have more renewable energy penetration, we will start to see a lot of the older conventional assets turn off and not provide these services. And I think BESS will be very, very well placed to participate in this market. And whether that makes up the missing money problem or increases the business case for BESS, I think that will be very exciting to see how each market takes its own view on how it will provide these services for each own market.
Okay, well, thank you both for your inciting look ahead. I can't wait to see next year how accurate we were as well. I'm pretty sure you guys are on point. I'd like to thank you all for joining this webinar and thank you to our speakers today. And I wish everyone a good day. Thank you.
Thank you.
Thank you.
Thank you. Goodbye, everyone.